But there are a lot of stocks which are moving around irrespective of the consolidation that we're seeing in the market. And one of them is TBO Tech, which is in focus on account of the acquisition that it did. $125 million is what they paid for Classic Vacations. And those are the important points that we will discuss with the management as well. The growth and synergies coming in from Classic Vacations acquisition, the near-term outlook on travel industry, and more importantly, overall long-term revenue mix and take rates as well. Ankush Nijhawan, who's the co-founder and joint MD of TBO Tech, joins in. Along with him is Gaurav Bhatnagar, who's again a co-founder and joint MD at TBO Tech. Gaurav and Ankush, thank you so much for joining in. The street clearly likes this acquisition. Ever since you've made this acquisition, $125 million is what you've paid to scale up your revenue in the US, which accounted for just about 5% of your gross transaction value. Ankush, just a question to you with regards to the operational and revenue scale synergies that you would get from an acquisition like this. Immediately, yes, it adds about 30 to 40% to your revenue. Brokerages estimate a 4 to 5% EPS accretion over the next few years as well. But from your endpoint, where do you think you can scale TBO's organic revenues because of this acquisition? And where could the cost synergies come in? Have you put a number to that?
Good morning, Mangalam. Mangalam, this question I would request Gaurav to take, if that's okay.
Go ahead, Gaurav.
Yeah, hi, Mangalam. Thanks for having us over. So, Mangalam, we have to look at this acquisition from two perspectives. One is the US market entry. This is one market where we had been the slowest to enter, and we had made a couple of attempts in terms of different strategies for the market. So this acquisition makes a lot of sense because now it gives a significant scale in what is also the largest outbound travel market in the world. So as our business matures, we would expect the business to reflect the global mix of luxury travel demand. And from that perspective, we would expect US to be one of the largest or maybe the second largest market for us. So this gives us a significant scale. The second aspect to look at, and which I think helps the overall business for TBO beyond US as well, is the access to luxury travel supply. We shared this data in our analyst call as well last week, that the average ADR or the average daily rate at which Classic operates is nearly $1,000 per night compared to the $250 per night that TBO does right now. So we've started from what we call premium outbound travel, so which is more like 4-star deluxe, early 5-star. Classic, on the other hand, firmly operates in the luxury end of the spectrum. So we start getting access to that supply, and that supply is relevant not only for the US outbound market, it's relevant for luxury travel overall, right? So for example, Europe is a big destination for Classic right now, and Europe is also a large destination for TBO. So we expect that, yes, standalone accretion from what we get from this business is what it is, and I think the analysts have a view on it. But we have to look at it from a broader perspective, saying that if the company's thesis has been that luxury travel is the segment that will grow, and this is also the segment that is largely serviced by travel advisors, then it helps us entrench ourselves in that end of the spectrum as well.
All right. Hi, Ankush and Gaurav. Congratulations on making this acquisition. It seems to be strategically good. And also, the street is optimistic because the kind of addition on the revenue as well as on the EBITDA front. So that's good. But a couple of questions out here. One is the acquired entity, the last 3 years there's been no growth. So do you see growth come back over there? If yes, where do you expect this business to scale from around $100 million? Point number one. Point number two, the margin gap is closer on 700 basis points. They are at 10%, you're doing closer on 17%. Will it be that, these margins of the acquired entity as well gradually moves up maybe to mid-teens in the next few years?
Yeah, no, fair questions, Nigel. Look, I think from a perspective of growth, two things to keep in mind over here. One, the US has seen a fair bit of turbulence last couple of years, right? Because of the geopolitical environment. So, for example, Mexico is a big destination for Classic, and outbound to Mexico has been, meaningfully hit from US overall. So, I think that is some macroeconomic headwind, which we expect to see a turnaround over the course of time. Second thing to keep in mind is that Classic was so far owned by not by a strategic owner, but by by kind of like a private equity / family office. So the priorities were very different, right? I think they still, in spite of a flattish top line, they did show bottom line growth. So the priorities were very different when you're owned by a private equity as when you're part of a strategic larger setup. So we definitely are banking on organic growth as well in the Classic business from the synergies we will derive. The way we'll also look at it is that how fast can the North America business or TBO as a whole, including Classic, can grow. And there we remain very optimistic. I think I'll not hazard to give any forward-looking numbers on this. We would definitely expect top-line growth to happen. On the bottom line, Nigel, I think we have to first understand how the Classic business is slightly different from the TBO business in terms of how revenue gets measured. So Classic works on what's a commissionable model. So you would see the take rates are very high, almost 23%. Now, half of that take rate is actually just commission that goes back to the travel agents. So about GP, is hence 50% of the overall take rate. Even at that, GP is quite impressive at 11%, which is more than double of what TBO does organically. So I see that as a big positive. Now, as you know, these businesses demonstrate operating leverages. So our expectation is that as we enable the business a little bit, all top line growth should meaningfully go down to the bottom line. And hence we should expect EBITDA margins to improve. Very hard to say, will the EBITDA margins converge at where the broader TBO margins are. But if I was to look at another metric of where is the EBITDA as a percentage of GTV, and this business is already accretive for us, right? They are nearly 2% plus on EBITDA as a percent of GTV, which is how many of the large mature OTAs, measure their financial outcomes. So from that perspective, this business is already accretive, and I think it'll grow from there.
All right, we take that point. But, from a improvement standpoint, if you could tell us, are you working with, say, 100, 200 basis points improvement? Yes, difficult to say whether they converge or not. But at least from what you can see right now, there should be at least 100, 200 basis points improvement?
Are you just, putting a little bit of words in my mouth there, Mangalam? But look, I think...
No, we're asking for...
We're asking you out of curiosity, because the current difference is close to around 500 basis points. You're saying it will obviously not converge. So I'm saying, will you meet them halfway?
That may be one way to look at it. I think in the short run, and look, we have yet to own the business in the sense that it closes in the first week of October, right?
Yeah.
So for us to be able to create such a granular perspective on the business is a little bit hard. We have identified synergies. I would be surprised if we don't deliver at least a couple of percentage points in EBITDA improvement over the next 2 or 3 years.
Got that. A couple of percentage points improvement in EBITDA and meaningful improvement in growth as well. As the ownership has changed, focus will change as well. Ankush, we asked you a question, you directed it to Gaurav. Let's ask you a question again. If you could give us a growth breakdown for the ex-Classic Vacations current business for you. The first quarter obviously was impacted by disruptions. The second quarter, have those disruptions continued? What is the outlook on growth for this year, GTV, on both airlines as well as hotels?
So, Mangalam, I think it was a very, very tough last quarter for the obvious reasons we all know. But I think Q2 is showing some promising traction. I think, and we are doing things which we're supposed to do. And yes, there is a lot of positivity in the market now. I think the Q1 is behind us. Plus, with the festive season, especially coming in India, with Diwali and the Dussehra breaks, we anticipate some good movement happening. And I think in terms of our forecast for growth, we are in line what we think we should be delivering, but as a company, Mangalam, we don't give any forwards. But what I can tell you is our focus remains, and hopefully we'll deliver what we have been talking to the market.
Okay, all right. I wanted to get your view on a direction for the profitability of the company. Because one would say, it's more than a $2 billion market capitalization company and giving net profit of 220 crores in the last year.
Yeah.
But the street is optimistic about the prospects ahead. So I'm looking at a Jefferies note. They are talking about profitability move from an early 200 crores to close to around 380 crores in FY27. And post that, they're also talking about 500 crores of net profitability. Do you think that's the direction the company is headed? Because if you take that into the equation, then the company doesn't look too expensive. What's your take?
So I think the 380, is obviously was something which was, not before Classic's acquisition, right? So we are fairly confident, to move in that direction. And obviously Jumbo Online, which was an acquisition, if you remember, Nigel, is now going to have a full year with us at TBO as well. And the 500, I think what Jefferies is obviously crores, what Jefferies is giving is keeping in mind our, full year of hopefully, delivering the Classic acquisition, as Gaurav mentioned in the beginning. So I think we are moving in the right direction. Plus, we believe that, sometime next year, our operating leverages will start playing up, because there has been a lot of front loading in terms of building our distribution, not just in India, overseas as well, very aggressively. So hopefully that will play up and give us some operating leverage, which we've been talking about in somewhere in 2026.
And at what level will the hotels and airlines mix sustain?
I think it's a conscious effort, Mangalam, for us to build a hotel business because that's where real profitability comes in. Nevertheless, our airline play in India is extremely important because one, it gives us a lot of meat in building our platform in India and cross-selling hotel business. Plus, I think the whole growth of aviation happening from India is something we cannot ignore. But yes, I would say at least 80-85% of business will be our hotels, which will obviously make our EBITDA and profitability much better because that is the higher margin business for us across.
Take that point. Thank you so much for that. The street likes the acquisition. Over the last month or so, the stock has rallied about 22%. You believe that with all the front-loading investments that you've made, maybe going forward, things would improve for you in the company. And that's what the street is betting for as well. Take a shot.